time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. KBL Linen Inc., symbol KBL on the TSX. Trades around $28.84. Stock is down 22% over the past year. The market cap $310 million, pays a dividend 4.27%. What does the company do? They are the largest owner and operator of laundry and linen processing facilities in Canada and a market leader for textile rental services in Scotland and the northeast of England. Now, let's look at in terms of the breakdown of segmented revenues for the 9 months of this year. In Canada, healthcare 74.3%, hospitality 9.2%. So the Canadian division in total of its total revenues over the 9 months, 83.5%. In the UK, healthcare is just 3%, hospitality is 13.5%. Total UK division is 16.5%. So primary businesses within the Canadian hospitality and healthcare market. Now, we're very familiar with KBL, having recommended the business way back in October of 2008 when Brennan was in kindergarten, and the shares were at $8.75. In 2011, while the company's shares traded at $22.56, we issued a sell rating, sell half near term, and later shifted their stock to a full sell in 2017 when the stock traded at $40. The reason for the rating shift at the time was the business was struggling to achieve its margin targets while it invested for growth. Since then, the stock has slowly declined. It's currently in the $28, $29 range. With the world reopening, the company's hospitality segment is finally back to pre-pandemic highs or levels. Let's look at in terms of the financials for Q3 of 2022. Consolidated revenues increased 19% to $73.63 million. EBITDA, though, decreased to $11 million from $11.6 in the same period last year. Net earnings were up to $2.5 million from $2.1 in the same period. The analyst estimates right now, well, if we can look at these for 2022, so at the end of this year, they're on a calendar year, 59 cents earnings per share. Or year over year, that's down 27%. Its PE based on that would be around 47. Now, if we look into 2023, there's supposed to be a huge step up, 197% growth in EPS to $1.76. That would be a tremendous jump forward. By 2024, the estimate is for $2. Again, if we look to 2024 EPS, that would be trading around 14 times earnings, but right now it's 47. So if they leap forward, it can look good. Now, we have talked to management a number of times from our analysis on the company and our conversations with management. In the near term, particularly for next year, these estimates would be aggressive in our opinion. Earnings should take a significant uptick in 2023, but these estimates, as they so often are from the brokerage community, are just too positive in the near term. Our take here would be the business pays a solid dividend yield at 4.27%, but it is not cheap on an earnings basis, and it remains leveraged. KBL can reach management's, if they can reach management's targeted adjusted EBITDA margin of around 18%, while generating revenue of about $270 million, which is the estimate for 2023. The business would then trade at about 8 times EV to EBITDA. That is below its historic level, but it is, again, still not cheap on an earnings basis, an actual earnings basis. And it is just, it's not massively below. It's about a 10% haircut to where its average EV to EBITDA multiple has been over time. We anticipate the company to continue to pursue M&A activity over the next 12 months, continue to monitor its numbers for Q4 and into Q1 to see if management can begin to achieve those margin targets. KBL has significant recession resistance, which we like, that strong dividend yield, and the direction of earnings over the course of this year should be very positive. But given the tight labor market and high input costs, the margin recovery will likely be slower than analyst expectations right now. As such, we monitor KBL closely, but remain on the sidelines with its PE based on next year's earnings in the range of 21 to 25. It looks better going forward at about 14 times next year's earnings. We'd like to take advantage of maybe over the course of this year, if we see those estimates, which we believe are aggressive, if they're missed and the stock pulls back, it might be an opportunity to buy shares. Right now, we're just monitoring KBRO. It's a good business. We'd like to see them, again, get back to the stated margin targets and produce higher EPS. We think that'll happen probably weighted towards the second half of this year and maybe into 2024. So there may be an opportunity at some point that we are monitoring in KBRO over the course of this year.